This is accounting lesson number 5, and keep in mind, folks, because of how extensive this lesson will be, it will probably be carried on into accounting lesson number 6. But what we're going to be talking about is the general journal. And the general journal is necessary because you can't keep charting things on a balance sheet or an income statement. As a matter of fact, the figures that come on the balance sheet and the income statement come from the general journal. Okay? And what you will find in the general journal is accounts like these: cash, accounts receivable, supplies, land, building, prepaid insurance, and so on and so forth. Now, in the old days of accounting, they used to have this great big book called the General Journal. And what you would do is you'd open it up and you'd write all these numbers down. And it was a long, tedious, arduous task. That's why these people got paid so highly. Some people still do it that way, but most people have gotten into the computer era, and so therefore they don't have to do that anymore. Matter of fact, most companies wouldn't survive if they had to do it the old-fashioned way. So now they depend on computers, and therefore we go on. The idea of a balance sheet is just like those weight scales right there. Everything has to come out balanced. So what you do is you close out the general journal accounts every month and transfer the balance from them to your balance sheet, and your balance sheet is supposed to come out balanced. Now, sometimes that doesn't happen, and then you have to add that arduous task of going back into the general journal, finding out what went wrong, fixing it, and then boom, there you go. However, let's talk about some of these accounts. Now, obviously, you got your cash account and you got your supplies account. Now, supplies literally mean this. And I'm going to say this to you because a lot of accountants, they spend their entire day inside a cubicle. They're not out into the like the factory, and they're not the ones manufacturing the merchandise, or they're not in the retail store standing out there trying to sell the merchandise. They're in some cubicle somewhere, and they have no clue as to what's really going on in the real world. Now, some of them have been fortunate enough to have worked in the real world and have some idea what we're talking about, but others got their little bachelor's degree and they have no clue as to what goes on in the real world. So, what are supplies? They're pens, pencils, paper, paper clips, staplers, staples, so on and so forth. Okay? Now, when you go out, you go to the store and you buy all these supplies. You're going to pay out cash. Now, some people, they write out a check. Other people have a corporate credit card. It doesn't really matter. Either way, they pay for these supplies. You don't get your supplies, you don't pay for them. And it doesn't matter whether you use cash, a check, or a credit card. That's what you're doing. You're paying for them. Now, then you have the supplies on hand. You have to tell everybody, especially the tax guy, hey, I've got X amount of pens in my office. Or I got X amount of paper. Or if you're a factory, I got X amount of paint, or X amount of bolts, or X amount of whatever. Those are supplies, okay? And later on, now keep in mind, you debit cash, you credit cash, sorry about that, you credit cash when you buy these supplies and debit supplies, because realistically, you still own those supplies even though you paid cash for them, alright? It's not until you actually use them up that you no longer own them. So, at a certain point, you have the supplies expense account, and what you'll do is you'll credit supplies and debit supplies expense to show that you've used up the supplies, okay? Now, you have an account where you have land. You're going to have an accumulated depreciation, not on necessarily land, although that might happen, but more likely you'll have an accumulated depreciation on a building. You go out, you write out a big old check. Now, I know some companies do this, some companies get notes to do this, so on and so forth, but they write a big old check and they pay for a building. Now, that building looks great when it first starts out, but you start making things in that building, or you start selling things in that building, the building's going to start depreciating because it's going to start falling apart. Let me tell you something, nothing just stays immaculate forever. Even if you do a remodel, it's not going to stay that way forever. So, the building starts to depreciate. That's why you have accumulated depreciation. When you're doing something like buying a building, let's say you are rich enough to buy the building, so what you'll do is you'll credit cash and you'll debit a building, because remember, that's an asset to you. Okay? Now, what about prepaid insurance? Now, you go out to a company and you pay them X amount of money to insure your building or your cars or whatever it is from getting damaged, whether it be from fire, from tornadoes, from floods, especially floods. Let me tell you something. Those businesses down in New Orleans, they can tell you all about prepaid insurance. Okay, so what you do is you pay out a certain amount of cash, you get this prepaid insurance, and it says for a certain amount of months, whether it be 6 months or a year, if something happens to your building, they're going to give you X amount of cash to make up for what you've just lost. Okay? Now, these insurance companies, they take that money you've paid them and they'll put it in some kind of an account, or they'll buy stocks with it or whatever, and whatever money they make off of that is how they make an income, and then the rest of it is held for you until such time as you actually need it. Alright, so they'll give you like a $10,000 policy or whatever. And what happens at that point is you'll have an insurance expense that will be debited, and prepaid insurance will be credited every month for 6 months until your premium has been used up. Okay. Now, what about notes payable? Let's say you need an emergency amount of cash. So you go out and you go to your bank, you say, I need $10,000 right away, and I will be able to pay you back within 1 year. Okay? So the bank issues you out a note, and you sign the note, and you fill out all the details, and then say you get $10,000. So that $10,000 goes into your cash, and then you have a notes payable and an interest payable on your liabilities, and then at a certain point you start paying back that note. And so what you'll do is you'll credit cash and debit notes payable and interest payable. You'll credit both of them, alright, until you get it all paid off. And that pretty much explains note payable. You could end up with cars and so on and so forth on your accounting statements, and I'll go over more of these accounts with you in my next video. So now you have a basic idea what's going on. If you need to know anything further, just leave me a comment and I will help you out. I will tell you more in a future video, so stay tuned.